Hey folks, let me ask you something. Is it okay to be selfish when it comes to your investing? Heck yes. You'll hear a lot of real estate people say, I love real estate because I can improve communities. I can put people back to work. I can help my friends get rich. And you know, all this is true and it can happen. But let's be real. Nobody is in this business to work for free. So it's okay to be a little selfish. You want to know how much you can make so you and your family can be taken care of. There's not a thing wrong with that. In this video, I'm going to talk about what everybody wants to know when they invest in a syndication. How much am I going to make? I'm also going to cover how it works and some key parameters that you should be aware of. So let's jump in. Hopefully by now, you know that an apartment syndication is a pooling of investors' money to buy larger assets. In this case, an apartment. But how does it work and what are you going to get in return? It is a fair question to ask. It's a question you should be asking. Is it possible to predict what you're going to make in the stock market? Not really. But you can actually get a very solid idea of what you're going to make in an apartment syndication. With apartment syndications, you're given a detailed prospectus, quoting projected returns based on market economics and a sound business plan. This plan gets vetted by the bank that will provide the loan, and also a professional property management company. The property management will oversee the asset and be involved in the execution of the business plan. So they, along with the lender, have a vested interest for the asset to succeed. So it isn't just you and your fellow investors who have skin in the game. So how is it going to work? When a syndicator finds an opportunity, they will send you a deal alert, followed by an investment summary that summarizes the details of the return, the business plan, the market, and the team running the deal. It lays out the story in great detail. They will follow up with a webinar to answer any questions that you might have. If you decide you want to invest, they will provide you with a soft commitment form that you can fill out. Now, once you are firmly committed, you'll be sent a few documents, including the private placement memorandum. This one is very long, the operating agreement, and the subscription agreement. These cover how the deal will be run, all the risks involved, and how to fund your investment. But now, let's get to the fun stuff. How much am I going to make? Suppose you have $250,000 that you've been wanting to invest, and you've decided to invest it into an apartment. When I invest in syndications, I aim to double my money within 5 to 6 years. You'll see the term equity multiple on the offering. For example, the equity multiple might project 2 times after 6 years, meaning your $250,000 is now worth $500,000. This sounds great, but other things are going on under the hood that will improve your position. Once the business plan has been executed, the operator may seek a refinance or a supplemental loan. With the rents and the overall revenue raised, the operator goes back to the bank and shows the improvement in the net operating income. They are then given a new loan based on the increase in value. The operator then returns all or a significant portion of the investor's original investment. Investors still continue earning cash flow on the property and will always share in the profits once the property is sold. The investor can now redeploy that return capital from the refinance into another syndication. So they're exponentially increasing the number of syndications they are now invested in. Thus, if the original $250,000 was divided into 5 syndications, by the end of year 2 or 3, that investor might now have an option of investing in 5 more apartments. This would bring his or her total number of syndications he or she is in to 10 only after 3 years. This is how the real wealth begins to build and why it may be short-sighted to only focus on your capital being locked up for the next 5 to 10 years. Remember that you are earning cash flow and you are getting portions of your capital returned to redeploy. Not always, but in a lot of cases you are. Now this is a good time to bring up the velocity of your money or your investments. You cannot just pay attention to the equity multiple and ignore the hold time. For instance, you may compare 2 deals where one has an equity multiple of 2 times, meaning that you are doubling your money but has a hold time of 6 years, whereas the other one has an equity multiple of 1.6 but has a shorter hold time of 4 years. So even though the equity multiple is less, you are churning that money faster as long as you reinvest it in another deal. Also important to remember is when there is a refinance, you get a portion of your capital back, but this also means you have less money in the deal. So even if that cash on cash percentage goes up, you're receiving back less cash flow. For example, if you're originally earning 8% on your $100,000 that you invested, you'll be getting $8,000 in cash flow per year, right? Now let's say you get $80,000 of your capital back on a refi, and your cash on cash percentage hypothetically jumps to 18%, You are now earning $3,600 a year, which is a great return, but if you are counting on that cash flow to keep your bills paid, you need to be prepared to find another good cash flowing deal. Now, we cannot assume that every business plan and every syndication will be executed perfectly. So what is the downside risk? Maybe there is a slowdown in the market. I don't know, like a pandemic. The return of investor capital could be delayed for a few years while we ride out the storm. Rent growth can flatten in a down market, so along with it, your cash-on-cash return may get reduced from 8% to say 3% for a few years. Now, if there is a preferred rate of return, also known as the pref, you will be given a catch-up of your returns. So if things were slow and you were earning only 3% 1 year with an 8% pref, then that 5% gap would be tacked on the following year and so forth until you are caught up on your 8% preferred return. So in review, we talked about the equity multiple, the hold period, the velocity of your money, and some of the downside risk. When you consider what I will get in return, doubling your money in 5 to 6 years sounds pretty great. But remember the multiply effect, the redeploying of your capital when it is returned. The number of syndications that you are invested in may jump from 5 to 20 in a shorter period than you may think. I hope it makes sense. If you're confused or have questions, please ask below in the comment section. And finally, if you enjoyed this video, hit the like button below, share it with your friends, and definitely be sure to subscribe. I'm Rick with Fortress Federation Investments. Until next time, thanks for watching.